What's up, everybody? Welcome aboard. I'm glad to have everybody here, even though it is a Monday, and I'm sure that many of you are sound asleep. And even though it's, I don't know if it's the seventh or eighth period and it's the middle of the afternoon, but you're probably too tired from the big win over Glenbrook North and the beatdown. But at the end of the day, it's time to learn some more about business. And as we, talk about, there's different ways and many different strategies to do. By the way, this is Bubba, Todd Bubba Horowitz, and so glad that I have your attention and you'd wake up for the next 10 or 12 minutes. We'll teach you a couple of new skills that we can certainly focus on and help you become better at what you're doing and give you a better learning curve. So one of the things about trading, and I know that Mr. Navickas has been teaching quite a bit, and some of it seems like it's a little bit complicated, and some of it seems a little bit difficult and challenging. But at the end of the day, if you look at the trading model and you look at everything as a mathematical odds and probability model, and not look at it as complicated trading, there are many different strategies that we can use. And we see patterns, and we talked about consolidation or congestion. We talked about breakout. We talked about blow off. And if we look at this chart here, this is really just what we would call a big consolidation pattern. Finds a level on the bottom, runs up to the top, came back to that same level on the bottom, went right back up. And this will work in a manner of speaking, and we will continue to see the markets turn back and forth until it does actually break out to a trend, which would be up or down, doesn't matter. Eventually this will break out of this range and start to make a move. And if you just look back in history of this particular chart, you will see that it has done the same thing over and over again, okay, and eventually will break out to a trend. As we see here, we saw the same thing repeat here, and it broke out, and we're seeing the same thing repeat. So if we go by the thought that everything repeats itself, then we know that that is true and factual. And once you believe in that, it will make the rest of your trading all that much easier and your understanding all that much easier. So we don't really care about what the name of the company is. We care how can we make money, because life comes down to two things, and money is one of them. Okay, so as we look at different strategies, and I know we've played a little bit around with buying stock and buying calls and buying puts, but there are better strategies and other strategies that we use in different types of market conditions. So when you focus on the different types of things we can look at and the different types of strategies that we can use, the next strategy after just either just buying the stock or just buying a call or just buying a put is a strategy we call credit spreads, okay, which is an income generating strategy that allows you, the trader, the investor, to benefit from market conditions when either you have an opinion that the market's going higher or lower, or whether you think the market is going to sit and consolidate and not move much at all. So when we talk about credit spreads, what are credit spreads? Credit spreads are a way of creating a position that gives you a net credit, okay, very much like you're going to become an insurance agent. Now, if you don't understand the insurance business, they sell you an insurance policy, whether it be for your car, your life, your home, it doesn't matter. They sell you an insurance premium. They sell you an insurance policy, and to get that insurance policy, you pay a premium. And what the insurance company is betting on is that a certain event doesn't occur in a certain time, and they're going to collect that premium, okay? And so if you buy car insurance, they're betting that you don't have an accident in the period of your insurance. Well, in options, we can create the same type of insurance policy. Okay, so if we move from the chart into the actual options model, and well, actually, let's go back to the chart for a minute. So if we looked at this chart and you subscribe to my theory that we are near a top in this market. Okay. If you believe that, okay, and you wanted to put a position on that was relatively safe, that had, minimal risk, minimal reward as well, but minimal risk, we could create a credit spread. We would call in this particular case, we would create a call credit spread, which is actually, when you sell a call credit spread, it is more a bearish strategy, thinking that you think the market is either going to sit here or go lower, because we are selling the call. Now, just to refresh, now wake up out there, because I know that this is sometimes gets a little dry, but wake up and listen. This is important. When we sell an option in general, when we are the seller, or called the writer, we are accepting an obligation. If we sell a call, we are selling the obligation to sell that stock at a certain price. So if that stock goes above that certain price, somebody on the other side of the trade is going to exercise that right to make you sell them that stock. So in this particular stock, if we sold the rights at 117, okay, then in the stock is trading at 117.70, somebody could force me to sell them that stock at 117 because I sold them that right. Because when you sell options, you have no rights, only obligations. So what we're going to teach you today is how to make this work for you and make it beneficial. So if I felt by the chart that this was reaching at least a top, and I'm not saying it's going to go down from here, but not going to go much higher, what I would do is a position I would create would be to sell the 118 call. So I'm going to sell rights to somebody, or I'm going to obligate myself to somebody that I'll sell them this stock at 118. But because the type of trading we do, we don't like to take what we call unlimited risk. So what we're going to do is not only are we going to sell or obligate ourselves to sell the stock at 118, but we are also going to buy the right. We're going to buy the rights to buy that stock back at 119. Okay, so we're going to sell it at 118, the obligation. We're going to buy the right back at 119. Okay, so what we're creating here is called a vertical spread. So in this case, we're going to want to sell a vertical spread, and the machine comes up and shows you a vertical spread. Now, we do these spreads typically $1 wide or wider, so we're going to make one adjustment here on the bottom, and we're going to buy the 119. So now, what I'm going to do is I'm going to sell the obligation to myself to sell the stock at 118. I'm going to buy the right to buy the stock at 119. I can do that for a 31-cent credit. What does that mean? It means I can collect $31 if this stock stays below 118 in the next 5 trading days. Okay, I collect $31 for every time I did this. So if I did it 10 times, I could make $310 this particular week. Now, how do we define the risk of this? Well, my maximum risk is I could have to sell the stock at 118. I could buy it back at 119. So my maximum risk is $1 minus the credit, the insurance premium that I collected. So my maximum risk here would be $69. So I'm risking 69 to make 31. But I have an advantage because the stock is only trading at 117.70. Okay, so I'm certainly in benefit as it begins with. And what other benefit do I have? I have the time of the clock ticking in my favor that will say, okay, so even if the stock goes up, even if the stock goes to 117.90, guess what? I still get to keep my 31 bucks. Okay, I still get to keep my money. The only time I become in risk is if the stock goes over 118.31 is my break even. How did I establish it? Well, I collected 31 cents. If the stock goes up to 118.31 and I have to deliver the stock to somebody at 118, well, I can always buy the stock right back at 118.31, which would mean I would break even. So that would be my break even. So what we're doing here is we're creating a synthetic insurance policy that will allow us to collect money if the stock does nothing, if the stock goes down, or even if the stock goes up 61 cents, I break even. Anything below 61 cents, I get to keep the balance. And I get to do all this and write this insurance policy for a maximum exposure of 69 cents, or in our case, $69. This is a bearish strategy, thinking that the market is going to stay static or go lower. Now, if I went to something that I thought was more bullish, or I wanted to put a bullish strategy on here, I could create the same strategy on the put side. So on the put side, I would sell vertical, and I would sell the 117.50. That's just out of the money, so I have a leeway in time. Now what am I doing? I'm obligating myself to buy the stock at 117.50, but I'm buying back the right to sell that same stock at 116.50. Again, a $1 risk minus the 34 cents, so for $66. Now, here I've got in a position that if the market goes up, I get to keep all the credit because nobody can sell me the stock at 117.50. And here I'm protected down to 117.16 because that's the credit I collected, and my maximum risk again is 66 cents. And these are positions that we create. These are like synthetics. They're called credit spreads, in which I am trying to generate a regular income. And this is a great strategy for somebody who's working a lot, who has a lot of homework, who just wants to gently put their toes into the market and learn how to collect credit, because collecting credit and selling options, becoming an options writer, is the best way to learn how to trade and the best way for you to become successful while protecting your long-term portfolio, or while just trying to make some spending money. And many of you will be off to college next year, and you'll be looking for that money to party with. And of course, this is a way that you can create a position, because this takes very little capital to do these trades, and it will allow you different opportunities to understand the market. Now, I'm sure that you'll have questions, so make sure that you ask Mr. Navikas all of your questions. I appreciate your attention. Now wake up and let's get down to work and let's make some cash. This is Bubba signing off. We'll see you back here next time. Thanks, everybody. Have a great